Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So the markets yesterday was absolutely crazy. Honestly, I've never seen anything like that in my life. So basically what happened was, at the beginning of the day, around midday, whatever, when the markets started, the Dow Jones was down almost 800 points. But at the end of the day, by the time the markets were closed, it was up. It made absolutely no sense, and nothing has changed. This is the funny thing, nothing has changed, right? Nothing, no good news came out of Russia and Ukraine situation, or the Fed hasn't said anything. Inflation is still the same, the job, anything. There was nothing to suggest that the markets should go up, but it did. Okay, and I'm not complaining. In a way, it's really good because, you know, as a long-term investor, I actually purchased a few couple stocks yesterday. If you want to check out what I purchased yesterday, go into my Instagram account. You can see it, right? So when you look at just what happened just yesterday, okay, just the markets, this is what happened. At the end of the day yesterday, it was all, you know, green, apart from obviously a couple of sectors. So it makes really no sense. And basically at the end of the day yesterday, even at one point, I think the Nasdaq was down almost 3%, but at the end of that basically night was all 3% up, okay, or 436 points up. So makes no sense what's going on. But like we've always said, just stick to your guns, stick to the plan, like we've talked about yesterday, okay, the last video. All you really need to do is just make sure that you're buying quality companies that are going to be around for a long time. And I've noticed there's quite a lot of new subscribers to the channel. A lot of you have asked me questions about what stocks to buy and this and that. So I thought today, let me have a look at it again in the just general, the S&P 500, the Dow Jones, pick the companies that I would have invested if I was starting from scratch. So if I was starting today, what companies would I actually put in my portfolio? Okay, and this is, so I've got 10 different companies that have a wide mode. They have a free cash flow, they pay dividends, they've been around for a long time, they have a company, basically products that everyone needs. Okay, and for that reason I've basically put those together, and I'm gonna share that with you in it now. So like I said, these are stocks that currently, some of them I own, some of them I don't, but I believe these are great companies that you could potentially add to your portfolio and forget about. Even if the world is going crazy, whatever is happening at that point, you genuinely do not have to worry about these stocks. You just buy them, hold it, and leave it there. So what are we looking for? We're looking for the ticker, the company name, the sector, stock price right now, the PE to kind of give us how expensive it is and so on in comparison to the market. Dividend yield, we're looking at the payout ratio. And the payout ratio is basically the amount of money out of the net income the company spends on paying you this dividend. Okay, the 5-year growth of that dividend. So we want to see if for the last 5 years, are they growing their dividend? Because that's important as a dividend investor. You don't want a company to stay paying the same amount every single year. You want them to grow every single year. Okay, so that feels like you're getting a pay rise, to me anyway. Okay, years of consecutive dividend growth. Okay, so how many years have they paid this dividend? Profit margin, are they actually a company that's profitable right now? We're looking about 10% or more. If we can find, that's great. We're looking for return on equity. So what the company doing with the money that you invested in? Are they actually, the management, are they great with that sort of thing? Free cash flow, the money they spend on basically buying other companies, paying you dividend, you're buying back shares, you know, all of that's great stuff. Then economic mode is, do the company have a competitive advantage? And all 10 of these companies here today we're going to talk about have all of them a wide mode according to Morningstar, which means they have a competitive advantage. And then according to Morningstar, not any other company, because they give you, I think Morningstar does give you a margin of safety, and that's what we're looking for. So if it's undervalued, then according to Morningstar, then that means it's really undervalued. Because if you look at the companies like TipRank and Yahoo Finance, they normally are not as strict as Morningstar. So I actually do like the fact that they give you a little bit of profit margin. So the first company we're going to look at is Johnson & Johnson. It's in the healthcare sector. It's currently trading $158 per share. PE is about 20, dividend yield of 2.63, payout ratio of 43%. Now we're looking for anything below 60%, so that's really good. 5-year growth, they basically, in terms of the last 5 years, they've grew their dividends about 6%. They have been paying their dividends over 59 years. Okay, so that's what's called dividend king. Dividend kings are companies who paid the dividend or increased their dividends basically 50 years or more. Dividend aristocrats is about 25 or more. Profit margin of 22.26%, which is really, really massive. And then return on equity of 30%, again, amazing. They have almost $20 billion in the bank right now. They can do whatever they want to do with. And they have a wide mode, and they are currently fairly valued according to Morningstar. So that's the first company. The next one is Home Depot. Home Depot, I own this stock, and it's gone down quite a bit in the last couple of days. They have amazing earnings report, but what happened was their forecast wasn't as great. So for that reason, it actually went down quite a bit. Currently trading $313 per share. They have a PE of 20. That hasn't happened for a long time. So I added to it yesterday. If you want to check that out, go to my Instagram account, you will see that. Dividend yield about just 2%, which is great. 43% payout ratio. They have grown their dividend 20% in the last 5 years. They have been paying their dividend over 33 years in a row. Profit margin of about 10%. Return on equity 1,240%. And free cash flow about $12 billion. They have a wide mode, and they are right now overpriced according to Morningstar. Okay, so about 28% from where it is right now. So if you're looking to buy it, maybe that's the price you need to basically target. Next is Colgate. I don't have this stock in my portfolio. It's on my watch list. I'm watching it. If it goes to 70 or below 70, I'm definitely adding this. I like this stable consumer staples. They're great companies. They have been around for a long time. If you go to your household right now, I'm sure you'll find a product that belongs to Colgate in your household. And basically every time you go to the shop, it's one of those things that you just pick it without even thinking about. Okay, whether there's inflation, interest rates going up, wars happening, people need this type of product. And this is the whole reason why we're doing this today. Okay, and then PE is about 30, quite high at the moment. Dividend yield about just above 2%, which is great. Payout ratio 56%. 5-year growth rate is not great, it's just 3%. They have paid their dividends almost for 59 years. Okay, and then profit margin about 22%, and then return on equity 320%. About 3%, $3 billion in the bank right now in terms of free cash flow. They have a wide mode, and obviously they are overpriced at the moment. Like I said, if it goes below just 8%, so if it goes below that 8% right now, I'm definitely adding this to my stock portfolio. And then the next one is 3M. 3M is going through some sort of challenges at the moment. Okay, there's some legal situation going on, so I'm watching that closely. But for the long-term investors, you don't really have to worry about that. Okay, whatever comes out of it in about 5-10 years down the line, we will forget about it. This company has thousands of different products, so they're not going to just disappear all of a sudden. I've added to it as well. If you want to check that out, go to my Instagram. Currently trading $143 per share. At some point this year, it was almost 180, so it's gone down quite a bit. P just 14, which is really good. And that because of the stocks went down quite a bit, the dividends actually quite gone up. It's now over 4%. Payout ratio 58%. Growth side of it, 5-year growth is about 6%. Years of conservative paying that dividends about 63 years. So the dividend kings, and profit margin about 22%. Return on equity 42%, and then they have almost a $5.8 billion in the bank. They have a wide mode, and they are discounted 24% at the moment, which is really good. Okay, and that's the reason I'm adding to. Again, they have a lot of the products they have is products that you generally buy without even thinking about. Okay, they have so many different products. They've got so many different sectors. So that's one of the reasons I've included in here. The next one is Visa. I'm sure you know about what Visa is. Currently trading $217 per share. PE about 43. A little bit expensive, but according to Morningstar, it's fairly valued at the moment. These companies have normally, the technology companies normally have a higher PE anyway. Dividends not great, but hey, they are growth companies, so I don't mind that at all. Payout ratio only 22%. last 5 years, they've grown their dividend about 15%, and that's what I'm looking for. So sooner or later, this will become about 1 or 1.5%. Okay, so in the next couple of whatever years. Then years of paying that dividend, about 14 years, profit margin of 66%. Okay, return on equity about 40%. They have $15 billion in the bank, wide mode, and fairly valued at the moment. The next one that we're looking at is Lowe's. Lowe's, again, is similar to Home Depot. They're very competitive companies. They are in the home improvement retail sector. Currently trading $213 per share, 18 PE, which is really low now. Okay, dividend yield of 1.5, payout ratio only 24%, 5-year growth rate about 17%, and then 58 years of paying that dividend. Profit margins of only 12%, but great. And then when it comes to return on equity, it's 655%. Okay, they have $6.8 billion in the bank right now. They're wide mode and they are slightly expensive at the moment. So if it goes below 200, I think I need to buy 4 more shares. So that's what I'm going to do if it goes below 200. Having said that, if it kind of dips maybe just below 210, whatever, here and there, I might just start adding just a little bit, half a fraction of shares, just to average it hopefully down some point. Okay, next one is Procter & Gamble. Again, is another company that I absolutely love. It's expensive at the moment, but is one in the consumer staples. It's a steady Eddie kind of company, but you're getting about 4% an increase every year in terms of sales side of it. Okay, you get good dividend, and they have been paying the dividend for a long time. So currently trading $151 per share, 26 PE, dividend yield about 2%, over 2%, which is really good. 60% payout ratio, which is not fine. 5 years growth in terms of their dividend growth is not that great in the last 5 years. But when it comes to paying that dividends, is 65 years of paying that dividend, increasing it every single year for 65 years. Profit margin of 22%, return on equity 31%, and they have $14.8 billion in the bank. They have a wide mode, and they have 28% premium. So they are a little bit expensive right now. The next one is the company that we spoke about recently in the financials. That's S&P Global, the company that actually started the S&P 500 and all that stuff. They are in the financials, but they normally tend to do credits and all that stuff just to kind of just the commodity markets and so on. So stock price $381 per share, P is slightly high, dividend just about below 1, payout ratio about 22%, 5-year growth rate is about 16%, which is really good, and they have done this for 48 years. Profit margin about 51%, return on equity 238%, and then you've got $3.5 billion in the bank to do whatever they want to do with, and they have a wide mode and they're fairly valued at the moment. The 9th stock is a company that we always talk about in this channel. That's Microsoft, currently trading $294 per share. PE slightly high, but for the tech, it's not that bad. You know, dividend is not that important to me when it comes to Microsoft because I'm looking from the growth side of things. Payout ratio about 20%, 27%. 5-year growth 9%, which is fine. In terms of paying that dividends, but they have been paying their dividend or increasing that dividend for 15 years. Profit margin of 42.52% and the return on equity about 50%. This is really good. Free cash flow of $60.6 billion on wide mode, and right now is basically cheap. The final stock that we're going to talk about is Waste Management. Currently trading $141. This is the company in America that collects all the garbage, does all sorts of recycling things. Okay, P is quite high. Dividend yield about 1.6, so which is really good. And payout ratio about 47%. 5-year growth rate about 7%. Years of paying this dividend 22, increasing this dividend 22%, and profit margin of 16, above 16%. Return on equity 20, almost 5%. They have $2.4 billion in the bank. They have a wide mode and then 17% premium. Now, every single stock in here has a wide mode. That means they have a competitive advantage. They have a free cash flow, so that means they're not losing money. Okay, they're making money and they actually paying you dividend while you sleep. So this is the type of stock that you need to add to your portfolio and make them your core portfolio. And then around it, you can actually get the Salesforces and the Adobes and the other companies that you like if you like the tech side of things, okay? But it's important that the main, core of the companies that you own are this type of companies that have been around for a long time, and they're not going to disappear overnight. Okay, I hope you enjoyed that video. If you did, please just give it a like. Thank you very much. Take care. Assalamu Alaikum.